Hey everyone, I think we should get into this now. So, my name is Miles. I'm the Director of Sales and Acquisitions. I'm here with Omar Khan, the founder of Boardwalk Wealth. Today's webinar is on the importance of the agency refi. We've wanted to have this conversation because of what we're seeing play out across the multifamily industry right now. So, what are we seeing exactly? Well, there's real distress in the market, and what's worth paying attention to is that it's largely not being driven by bad properties or weak fundamentals, which is very interesting, actually. It's being driven by debt service issues. Sponsors are struggling to secure extensions or refinances on maturing loans, and many of them don't see a clear path back to positive cash flow, unless, of course, the Fed drastically lowers the rates. Fingers crossed. So clearly, that's a difficult position to be in, and it highlights something that doesn't get talked about enough. That is, the loan structure matters just as much as the property itself. A good deal with the wrong debt can still put you in a very tough spot. So, when we look at the landscape, the question becomes, what is the gold standard of real estate debt? And the simple answer, and the answer we're going to unpack today, is agency loans. For all of our audience, these are mortgages for residential or multifamily properties that are backed, purchased, and securitized by government sponsored enterprises. These are primarily Fannie Mae, Freddie Mac, and Ginnie Mae. So here's what we're going to walk through today. Omar's going to explain why agency debt is in a class of its own. Then I'm going to take you inside a Freddie Mac refinance we just locked in, what it actually looks like to get it done. And then we'll talk about why Boardwalk Wealth is able to secure these loans when a lot of sponsors can't. But first, Omar, why should sponsors and investors want to secure agency loans? And why is it that most can't?
Well, look, if you're an investor in multifamily right now, the biggest single risk, as Niles mentioned to you, is not your property because properties typically don't go to zero, they have a residual value. The biggest risk is your debt structure that you put in place. And agency financing is the golden financing in our line of work. Typically, the rates run anywhere from, I don't know, 200 to 500 basis points lower. So 2% to 5% lower than non agency lenders. And on our most recent refinance, Lofts, and we'll get to that in a second, we were able to reduce our cost of financing between, I think, about roughly 250 to 330 basis points. So this is translating into annual debt service savings or annual mortgage savings of approximately 900,000 to 1.1 million dollars going directly to the bottom line. Now, this is the difference between actually distributing money to your investors day in, day out, month in, month out, or going to them with your hat in hand to ask for money. The other underappreciated element over here is agency loans provide you real runway. Because the other problem a lot of folks have right now is they frankly run out of runway. Agency loans, I mean, you go anywhere 5, 7, 10 years, you can go a little bit longer than this. They provide you that runway because real estate value creation, it just doesn't happen in 12 months. This is not an AI business or a software business where things are just going to happen like that. This takes time. You need time on your hand.
Yeah.
Lastly, the underwriting is very rigorous. So agency lenders require stabilized properties. This means 90% occupancy for 90 days. They have to be performing. They can't be like non performing assets. And not every property qualifies. Not every sponsor qualifies.
Mm.
So they only pick the best of the bunch at typically lower leverage points and non agency lenders. But in exchange, with all this scrutiny, you're getting really accretive cost of financing. So that gives you some idea. Now, I've got some numbers over here. So I'm going to be looking down just to refer to some stuff. But what I do want
You
to
didn't
put down
memorize the
is,
numbers? I expect you to memorize these numbers, please.
you know, Miles, even I'm not that big of a savant. Right. So look,
Fair, fair.
while industry, I feel you're going to hear a lot of chatter from sponsors that, oh, we've got the wind at our backs and we're going to do this, we're going to do that. I think a lot of these supply related, capital markets, debt related issues, they're going to take a few years to resolve. So this is why exactly folks like us, we've chosen to actually solve the problem than merely kick the can down the road. So that's sort of kind of really important. Does that kind of, I mean, does that round out with your experience as well, Miles?
Absolutely. Yep, I agree completely.
One of the things also that I'd like to mention, this is an internal joke with our team, but a lot of sponsors we talk about as well. You're going to hear, if you haven't heard already, a lot of chatter from multifamily syndicators, sponsors, operators, advertising income funds or some version of an income fund. And what they're basically advertising are high distributions to investors who come in today because they're typically helping solve some sort of cash flow or debt servicing gap problem. And on the face of it, a lot of investors feel like this is a good deal. I can tell you this is completely asinine because think about it logically. Sponsors have a cost of capital problem, as in the cost of capital is very high.
Mm.
And their solution to solving that cost of capital problem is to add a higher cost of capital. So now your cost of capital is going up. This is lunacy and insanity. A lot of these people are just trying to cash themselves out and take investors' money.
Yeah,
What they'll then do with this income fund more often than not is get an extension from a lender. Well, the extension doesn't necessarily solve any problem. In fact, we'd had it written down. The problem is twofold. The cost of the debt is too high. There is too much leverage in the capital structure, and your time is running low.
yeah,
So an extension doesn't solve any of these problems. In fact, you've not reduced the interest rate, you've not delevered the loan, and you haven't meaningfully extended the term of your loan out. Like in our case, we have 7 years left on our term now. So there is no meaningful increase because these extensions are maybe 1 year at most. And all you have done in this situation is given the lender more money from the investors. You've bought a minuscule amount of time, but it's not as big as you think it is because once you get a year's worth of extension, you have to understand at the 6 month mark, understandably, your lender is going to come back to you and ask you, hey, what's your plan? What
right.
are you going to do? Are you going to refinance this loan? Because even closing a conventional loan, no problem, usually takes 2 to 2-ish, 3-ish months. So
Omar,
you're right.
is it fair to say that sponsors basically find themselves in a hole, and a lot of the options you're outlining are in reality just digging that hole deeper and deeper? And
Yeah.
that's really, when you juxtapose that with an agency loan, what position does it leave the sponsor relating to these
Well,
others that are digging you deeper, really?
Miles, this is a public forum, but we would put this comment under the no shit Sherlock category.
Yeah, that's
Right. You have to remember, look, you guys as investors have to understand when you engage in these activities, when you give this income fund sponsor some money, and and this is what the strategy is. Assuming if it's a different strategy, then of course this doesn't apply. But if it's to solve this, oh, I'll get an extension for 1 month. I'll give you these super high distributions. You are subsidizing very near term pressure today. Within the short to medium term, you are now setting yourself up for even more severe consequences.
Right.
You are hoping that interest rates in 6 months, 9 months, a year fall dramatically, the market rips up dramatically, and all of these combination of items happens together. That is not a strategy. That is a hope, maybe a prayer, and that is how good people end up in bad situations. So compare that again. I want to just say, compare that again with what we're doing. We reduced our cost of financing meaningfully between, I think, 250 to 330 basis points.
Yeah.
We extended our term for 7 years. We did it at a lower leverage point. So now the cost of your debt is lower, your term is longer, the risk is reduced. So you're solving the problem today versus postponing it.
Yep. Agreed. Totally agreed. All right. Well, with all that said, let's take a look inside what this actually looks like in practice. So we're getting into the weeds now, folks, and I pray that you stay with me on all this. We just locked in a fixed rate refinance with Freddie Mac, so one of the agency lenders we mentioned previously, on our property Lofts at Eden, which is in Sanford, Orlando. This is a 7-year term, 5 years of interest only, which is amazing, and at roughly 5.3% fixed. It's a far cry from a lot of loans that are in existence right now. This is agency debt in action. So first and foremost, I want to be upfront with you. This took over a year of active capital markets work and was not a refinance that people expected to get done. Omar and I always joke, we've aged tremendously. I aged all in one fell swoop when my beard went gray and my hair was gone, so I'm good, but Omar has a beautiful lush, head of hair, so I'm worried a little bit for him. But I say all that to say this was arduous, it was painful, and again, we speak from firsthand experience. And I'm telling you all of this because investors should actually take comfort in knowing how difficult this process is. The highest level of scrutiny means the operations and the sponsor must be airtight. Freddie Mac is not handing these things out and they're not messing around, trust me. So let me walk you through what we delivered to get here. When we took over Lofts in 2021, occupancy was around 90%. We turned that around to the high 90s consistently. The submarket sits at about 93%, so we're outperforming the market. We drove rent increases of over 357 per unit, and NOI growth came in at 83%. That includes fee income. And the result of locking in this agency refinance is about 900K to $1.1 million per year in debt service savings, which is massive. And lastly, and I don't say this with hype in mind, there's still about $100 to $150 per unit in remaining upside on those units. Now, Freddie Mac doesn't just look at your numbers in isolation, of course. They measure you against the market, and here's what the picture looked like for us. At the one bedroom level, our rents were comparable to the submarket, although we were delivering that at lower square footage, which means our revenue per square footage foot is actually stronger. On two bedrooms, we're actually priced slightly higher than the market. And an important fact is that brand new construction in the area is offering multiple months free in concessions right now. And we thankfully have not had to do that. Our occupancy is holding without giving away free rent. On the operational side, our delinquency is low. We rarely have an eviction, and our turnover is also low, which means strong renewal rates. And all of that is to say, when an agency lender sees that, it tells them this is a stable, well run asset, not a property being propped up by concessions or short term tactics that can really hurt your chances in securing an agency refinance. Again, I reiterate this multiple times because I clearly have PTSD. None of this is smooth. Let me
Oh,
tell
yeah.
you let me tell you
Yeah.
about the hurdles. So first, the sheer level of scrutiny is impressive. Omar mentioned it. It's impressive. You don't really know that level of scrutiny until you've gone through it. Agency underwriting is intense. The volume of questions, the level of documentation takes time, and there's no shortcutting it, and there's no rushing the process. You have to truly be prepared to answer everything. The second hurdle was keeping performance consistent over a sustained period. It is not enough to have one good month or one good quarter. They want to see your numbers hold. That is occupancy, collections, renewals. All of this has to be steady with no dips. And lastly, we had to keep pushing NOI to get the loan proceeds where we needed them. And that's a real tension because you're trying to operate the property at the highest level while simultaneously meeting specific financial thresholds that affect your refinance terms. So this clearly requires constant attention. You know what I'm picturing right now, Omar, is the circus actor that's balancing the plates
Yeah,
on the
yeah, yeah, yeah,
stage.
yeah. While on the high wire, right?
That's
Yeah.
basically what we did for the last year. So the question is, what ultimately got us across the finish line? Well, again, I don't want to belabor this point, but consistent outperformance was key, not a spike, but a track record of operating above the market. And behind that is something that doesn't show up in a spreadsheet and can't be overstated, and that's the depth of our team and the way we operate. Our team is in the weeds on these properties constantly. Our record keeping, our reporting, our ability to supply the agency with anything they need in the format they need it on their timeline is crucial. When the lender asks for something, you can't scramble. You can't take weeks to deliver. You have to already have it. And then lastly, and honestly, it came down to relentless persistence. And I have to give Omar credit here. You know, we were relentlessly speaking to folks, and over a year of capital market work, staying on these people, uh, especially those that said it couldn't be done. That's really where we were able to push this over the finish line. So that really is saying that the reality of agency refinancing rewards operators who won't quit. So, the point here isn't again to pat ourselves on the back. Pardon me. The point is that this is what it takes, truly, and that's what this whole webinar is about. Agency lenders are looking for sustained operational performance. They're not. It's not a story about what you plan to do. And that's exactly why this type of debt is the gold standard because not everyone can get it. So, with that, Omar, let's talk about why Boardwalk gets these loans when others can't.
So I think, first of all, it boils down to three big pillars that some of this Miles has alluded to. They're the three big pillars for us, what we feel are operational excellence, our capital market sophistication, and relationships and reputation. So let me start with the operational excellence, as we call. Number one, we are blessed to have an exceptional team. We share not just professionalism and our passion and desire to go solve these problems and be great stewards of capital for our investors. What we also share is a similar mindset and culture of always trying to do a little bit better every day
Right.
because we know the market is very competitive. We naturally are very competitive people. And it's one of those things where even if you've been in the business for, say, decades on end, you're always learning new things. People keep bringing up new things. Give you an example. One of the areas where we feel we've really outperformed and excelled against most folks, I think, that I know of, and other people have externally validated as us, is basically on fee income optimization. Now, a lot of folks will focus on rent rentals. Miles talked about $357 of rent increases. The often underappreciated element of this entire business also is how much can you drive fee income? The reason is because fees are your ancillary income. And the way we look at it is we have to look at total cash collections. What is the total amount of cash that the property can generate? So a lot of folks you hear in this industry talk about renovation premium this, or I don't know, I put a golden toilet and I got more money. Well, that's really cool, but there's diminishing returns
That's
because
pretty
no, that's
cool.
pretty
Sorry to
cool.
interrupt. That is
Yeah,
pretty
I
cool.
mean,
That's pretty
I
cool.
don't
You
know.
could have used a better example than golden toilet because I think that's pretty cool.
Never
Sorry.
know if I want to be in an apartment with a golden toilet. I'm just going to be honest with you. I might. That would not be the best.
With gold prices where they are right now, you might want that. But go ahead. Sorry.
I don't know, man. So, but good catch. The point basically is you'll hear a lot of people talk about these renovation premiums. These are nice. The problem is the market has gone sideways in most major cities in America, especially in the Sun Belt, in the last 2 to 3 years. This means your rents are sideways or negative. In fact, one of the
Right.
brokers in Dallas, where I live, has told me that in the last, I think, 31 months, this is in a row, the rents have either been flat or negative. Think about it. Rent growth has not happened.
Right.
So no matter how much money you're putting in, you're not getting that premium that people were getting. So why
Where's the
would you do that?
ROI?
Number one.
Mm.
Number two, there is increasing pressure because costs are going up. This is not just in multifamily. Think about the grocery bill you're paying. Think about your cost of living. That is growing up. That is just going up every month, right? So when we hone in on fee income, these are ancillary services like cable, washer dryers, covered parking, all of these stuff that we provide to our customers who are our residents. We provide them a better quality of life. We make sure that every time we are performing a service for them, it is adding to their pleasure of staying within the community. And as a result, we can charge and get a share of their wallet that they would otherwise take and give to somebody else. Think about Wi Fi as an example. We have Wi Fi contracts on most of our properties. I mean, this isn't revolutionary, but as an example, we charge $65 to $85. We pay $30 to $35. We keep the spread. Now, most, if not all, of these residents are going to be paying for Wi Fi from a third party. Why can't it be us? So, adding and driving all of that fee income, that is just optimizing your assets basically to a level where it's really not a lot of people can compete. The other thing that I want to say on the operational excellence side is look, a lot of these operators that have scaled, especially say 2021, 2020 to 2022, they have been very effective at raising capital because they are marketing heavy organizations. So you will see they will have these glossy posts, 25 co GPs on their deals, and it's just marketing, marketing, marketing. And there's nothing wrong with that. Marketing is important for every business, but eventually you can't have just a business where everybody's a leader, nobody's a follower, right? These organizations are marketing heavy. Most syndicators are marketing heavy. Operations are an afterthought. And all of that is nice and cool when the market is going up 10, 20, 50% a year. Well, what happens when the market doesn't go up that way? What happens when you, as an investor, have given your money to somebody? They should be good stewards of your capital. When they treat operations as an afterthought, then this attitude has permeated throughout their entire organizations. This is why you see so many syndicators failing. Frankly, yeah, some of this is market, but a lot of them is them. And the issue is you cannot flip the switch overnight. You can't just be like, okay, I'm just going to go marketing, marketing, marketing. To I'm just going to do operations, operations, operations. It doesn't happen like that. Either you have it or you don't. It's like asking a fish to climb a tree. It's just not going to happen. So a lot of these indicators, they have big portfolios. They continuously go out and raise money, but you can see from their performance, it's not really going anywhere. They're not operationally competent at their very core. This is why you're seeing so many failures and operational discipline, which we religiously adhere to because we were beating this drum during good times as well. This is not glamorous. This is doing simple day to day items for years on end.
Yeah.
And off, it's like sort of like think about being a goalie, right? You can have 100 saves and nobody thanks you. You let one, goal happen and everybody's on you. So it's that sort of an environment. But this is where markets like this is where the wheat and the chaff get separated. And you as investors have to realize that you cannot be giving money to people that are just marketing, marketing, marketing all the time. They have to have operational excellence in their core. But then just being a real estate person doesn't cut it anymore. You have to have top talent in other areas of your company. As an example, if you do not have capital market sophistication, it is game over. Those days are done when you could just be a good real estate person. Look, securing agency financing or any sort of complex financing, it requires knowing more than a loan broker or knowing more or repeating all these buzzwords that you hear about. I mean, you need to understand the nuances of the loan. You need to understand how to negotiate, how to present your asset. This is a difference between knowing what a lender wants to see and how they want to see it and hoping things work out.
Omar,
And
question for you. I
yeah.
don't want to interject, but a question for you. If Is it fair for our audience when they're evaluating sponsors, how important is it to look at track record of getting these refinances done? And what I'm really asking is your experience doing agency refis in the past. How much does that play into your ability to get them done today?
It's a mixed bag, and I'll tell you why. Because will see a lot of people with big portfolios, so that's a track record, right? But what you don't see is what year did they buy those portfolios? When were they operating? As an example, if you sold a lot of assets, if you bought assets in 2015, sold them by 2021, you look like a genius. Well, what happened after that?
Mhm.
Number one. Number two, agency criteria has not tightened. Their scrutiny has tightened. And the fact that agency financing is like an escape valve, escape hatch. The fact that people can still do agency financing gives you an idea into their level of operations, capital market sophistication. And the reason why I say this is look, because my background as a CFA charter holder, it's not just something nice that is on a business card. No, because frankly, after a few years, nobody really cares. But what it does is it provides me extensive capital markets experience. It, it helps me to basically present the picture to our lenders and our stakeholders in a way that provide the most accretive outcome to our investors. And the last pillar is reputation and relationships. And this is the most underappreciated pillar because during the good times, nobody cares. Money is flowing, everybody's happy, everybody's fat, it's a great time. But during stress times, lenders and investors, by the way, but definitely lenders, they're your biggest stakeholder in the deal. They remember people who are organized, who are timely, who get back to them on time. This is goodwill, is like credit in the bank. You need to have credit in the bank so you can cash it at the right time. Look, a concrete example of this is basically the cash out refinance we did last year for Pines of Lanier, as an example, right? In all of the 2022 bridge book for that lender, it's a nationwide lender, $15 billion plus. They had only two cash out, as in cash money was taken out and distributed to investors. Two cash outs only happened in their 2022 vintage. One of them was us. We were the biggest cash out in their book.
Mhm.
That develops your relationship because now you've seen you can go through all levels of the life cycle. This does not happen because of luck. It happens because of your operational excellence, your capital market sophistication, but now also because of the relationships. And relationships are like anything else. They take decades to develop, but they can take minutes to unravel.
And we mentioned to everybody that it
Yeah.
took over a year to get the refi done on Lofts. How many loan originators, lenders did we chat with over that year plus period? Honestly, because I think that will give people a sense for how important relationships are and how you really need to dig deep when you're chatting with people and keep conversations
So
going.
we cast a very wide net because the way we looked at it was we want to cast a very wide net. We want to make a market and get the most accretive terms possible.
Mhm.
And a lot of folks we talked to, and but look, candidly, there were lots of times in this stretch when the capital markets were just not cooperating with us. Rates are here, something's happening, blah, 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 blah. People get spooked. But the point was, we cast a very wide net. We did not leave any stone unturned. And the sophisticated manner at which we conducted this process, even our counsels, ours and the lenders' counsel, by the way, commented on how sophisticated a process it was and how refreshing it was from their angle. The point is, if I didn't have these relationships that I hadn't built, and by the way, these relationships aren't built because you go have a drink and you have a steak dinner with somebody. That's all nice and cool. If you don't perform over the years, nobody's going to put their neck out for you. That's just the way it is. It's a performance related business.
Mm.
So the fact that it took this year, this long, the fact that we cast a wide net proves to you that how difficult it is a feature, not a bug. It gives you importance to know that this has gone through the most intense rigmarole to get to this stage.
Right.
Right.
Yeah.
Yeah.
No, that's good. At the end of the day, for again, everyone who's watching this webinar, what we want to do is arm you with the information to understand these agency loans, but then also to understand what questions you should ask your sponsor, right? Like that's really, I think, what we're able to do here when we're walking through some of the experiences we've had. You're able to go to a deal or a sponsor that you're interested in, and you're able to ask these very poignant questions, very targeted questions about track record, about relationships. You're probably going to catch people off guard, but these are things that matter today. And again, I think it doesn't I can't overstate enough how doing an agency loan is an amazing amount of scrutinizing that the investors benefit from because we have to go through that rigmarole, to use your term, Omar. And again, it's proof of concept really when you're able to come out post finish line.
Yeah.
Well,
So look, let's get into questions or anything.
yeah,
Like, what do we do? We
yeah,
got a
that's
bunch.
right. Yeah, so let's open it up to questions, everyone. We appreciate you staying with us up until this point. If you haven't already, go ahead and drop your questions into the Zoom Q&A, and we'll get to as many as we can. And for anybody watching the replay after the fact, or if we don't get to your questions today, please feel free to email me directly at miles@boardwalkwealth.com. Always happy to follow up with you personally. All right. While these are coming in, let me hit a few, Omar, that we've already received. The first one is a good one. Have you run scenarios, pardon me, where long-term agency refi actually becomes a poor choice?
Yeah, yeah, we actually did. I mean, look, like when I told you we were making a market, that's one of the scenarios because you can't just be saying I want to meet people who agree with me. But I don't want to test my hypothesis in scenarios where it is contrary to what my feelings are. No, look, if the market rips, say, 20-30% this year, and it does it again 20-30% next year, and rates go down, and don't use this as a number, but as a guidance post, say 50, 100 basis points year over year now, right? Yeah, then this locking in long term agency financing could be a poor choice, relatively speaking, because you could have just presumably sold these assets and made money and harvested capital quickly. In our case, though, we felt it was better to lock in a 7-year rate, 5 years IO, leave a lot of optionality on the table because these are assumable loans at the end of the day, because we're not trying to time the market. We're not trying to get this extra 25, 50 basis points because I feel everybody tries to do that because somehow people have this idea in their head that they have this magic ability to predict when the president of the country or the Fed or what they will do. That's not our business. We're not in the business of speculation. We're in the business of investing. So we feel putting this agency refi, it's an assumable loan. It eliminates refinancing risk. It locks in 900,000 to I think $1.1 million in debt servicing costs.
Right.
Gives us 7 years to pick the optionality of picking the right exit window. And look,
Yeah.
if the market does rip, we still benefit on the asset value side. And I'll take that trade every day. I will take the trade of being down the fairway, middle of the road, steady Eddie every single day. That these swings of volatility, where frankly, eventually most people end up burning themselves.
Yep, that's right. And again, there's so many folks, including us, we've been in these positions where your runway is evaporating. And what agency loans are able to do is buy you time and optionality. Again, to reiterate your point, and that's what you need in a market that we find ourselves in today. You need the time. You know what I mean? It's not an asset problem. It's not necessarily an operator problem. Fix the debt, buy yourself time, live to fight another day, and again, get the money that the assets deserve in a sale in the future. Okay,
Yeah, man. Absolutely.
next question. I think you've more or less answered this, but I think it's worth raising again. Have agency lenders changed their requirement since the Fed's big rate raising spree? And if so, how have they changed?
Look, in our estimation, having done this 7 or 8 times now, I don't believe the agency lenders have formally changed their requirements on paper. So DSCR covenants, LTVs, limits, basic qualifying criteria, 10% of liquidity, 110% balance sheet of the loan. That's all been there. What has happened is the depth of the scrutiny that is happening. So the level of questioning they will do on all of these items and how many times they'll ask you that and all of that stuff. And I believe part of this is a response to all the foreclosures that are happening. But what we've also been told is a part of this is also a response to what was surprising for us is rampant fraud in the system.
Right.
So I guess this is what happens when you're in down markets. There's a lot of you find out really who's swimming naked, basically, as Warren Buffett said. So only operators that have a clean track record, and we're talking pristine track record, strong operating teams, great assets that have proven that they can perform across the business cycle. Only those folks are now basically being let into this club. And it ain't easy to get into this club, but when you're in the club, it's pretty nice.
No, agreed. Agreed. We're at the half hour mark. I'm going to finish with one question. This is more my question for you, Omar, maybe as a sneak peek to a future webinar that we need to have. I'll base that on feedback I get from investors. So I know people have heard you talk about this before, but is this tied into your theory of shadow banking that you've previously mentioned?
Well, first of all, it's not a theory because I didn't coin the term. I wish I was that creative to coin these terms. I didn't. So, guys, you have to understand, as a result of the 2008 crisis and all the regulations that was foisted on the banks, what has happened is there is rise, a big rise in non-bank lending. I mean, I use these words in quotation marks. So, what is happening is there is a non-direct lending, bank lending ecosystem of bridge lenders, uh, debt funds, non bank originators. And most of these people or entities provided the fuel for this excess, this easy capital that fueled the 2021, 2022 acquisition boom that we are now facing the repercussions of. So, two groups are now trapped because usually people think, oh, it's the borrowers that are trapped. Well, borrowers are obviously trapped because they took on floating rate, short term debt, high leverage. They cannot refinance into agency debt most times. And oh, by the way, the market is so bad that even if they tried to sell, if they're selling, they're either a forced seller, which means most of their equity is wiped, or if they have some time, they're not really thinking about selling because the price that the market is going to give them is not going to be something that is palatable, at least in
Right.
the near to midterm, right?
Right.
Well, the other problem also is these non bank lenders, by the way, are also trapped because they are similar to syndicators of sorts. They were also in the business. Say, I'll lend you money at very high interest rates for, I don't know, 1, 2, 3 years. And you're going to flip the asset because it was a flipper mentality. You're going to flip the asset or you're going to refi. I'm going to get my money. So for that short period of time, I don't have relatively equity like exposure, but I'm getting close to equity like returns. Well, they're also stuck because if these loans are not being harvested, their liquidity is also struck. So like we talked about, agency debt, it's sort of like the escape hatch in the system, right? It's the release valve. If you qualify for agency financing, in effect, you are going from non-bank, non direct lending, from banks into this agency thing, and you've kind of sidestepped this whole system, but you've had that escape valve happen to you. That valve, that escape hatch is not available right now to a lot of people. Their assets might not be operating, their track records might not be clean. So now what you're having a lot of people extend and pretend, pay more fees to their lenders. They just kind of have to. Everybody's run out of money and they're stuck. Everybody's stuck. And that's like the shadow banking trap. And that's a liquidity problem. People do not have liquidity because they cannot sell, they cannot refinance, and they're stuck.
Mhm. Perfect. Love it. Omar, I think we end off there. We appreciate so much everyone in attendance today. Looking forward to your questions. Any final words, Omar?
Look, I feel, look, everywhere there's distress, you have to understand there's opportunity. And to give you some context, we have sourced and executed on 11 distressed transactions in the last 2 years, close to 2,000 units for an institutional partner of ours. And you'd be surprised that the discounts we were getting were anywhere from 25% to 40% relative to peak market valuation. So that gives you some context about the juicy discounts we were able to get. And to further capitalize on this strategy, because I feel in the next year or so, uh, a lot of sins have to be atoned for, and we want to be there to capitalize on that. We're going to be rolling out a special situations fund to capitalize on this dislocation. We'll share details later. That's not the problem. But what I'm trying to say is, guys, remember who you are investing with, what debt structure they're putting on. That is oftentimes way more important than the actual property you're investing in.
Mhm.
And some people learn this lesson the hard way, but intelligent people learn this lesson easily.
Perfect. Well, thank you, everyone. I hope you have a wonderful rest of your Thursday and looking forward to chatting with you all soon.
Thank you. Bye for
Thanks,
now.
Omar. Bye.